Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The global relief rally loses steam. Asian stocks snap a 5-day winning streak on mixed signals from the White House on its China tariffs plan. Ramping up the pressure, Donald Trump calls on Ukraine's Volodymyr Zelenskiy to accept a peace deal that critics fear could favour Moscow. Plus, more trouble at Gucci as Kering's key brand reports another drop in sales amid softening demand for luxury. Earnings front and centre for us. The top lines coming through from French lender and investment bank BNP Paribas. It is a modest miss in the first quarter when it comes to net income for BNP Paribas. 2.95 billion euros. The estimates had been for 2.97 billion euros. In terms of loan loss provisions, slightly lower than the estimates, so that is a positive for BNP Paribas, with loan loss provisions in the first quarter coming in at 766 million euros. The estimates had been for a little over 825 million euros. In terms of the return on total equity for the full year, they see an increase of 11.5%. The important lines on fixed sales, so fixed income, currencies and commodity sales and trading revenue, coming in a little softer, marginally softer than the estimates at 1.68 billion euros. The estimates had been for 1.71 billion euros. We'll break the details down for you with BNP Paribas in the next couple of minutes. The redhead on the net income line coming in just slightly, modestly below the estimates. We're going to be speaking to the CFO of that lender, Lars Machinel, at 7:10 a.m. UK time, so stay tuned for that interview. Switching focus to the consumer goods space, of course, consumption and Nestle. First quarter organic revenue coming in above the estimates. It's a beat for Nestle in the first quarter on organic revenue, 2.8%. That's the increase. The estimates had been for an increase of 2.57%. Nestle shares are up 20% year to date. We know there's a focus on to what extent they can continue putting prices up on the back of higher costs around cocoa and coffee. First quarter sales for Nestle coming in at a beat as well. 22.6 billion Swiss francs. The estimates have been for 22.4 billion in terms of first quarter sales. So organic first quarter revenue beating estimates for Nestle. On the autos front, we had some top-line numbers in terms of auto sales in Europe. Now the details coming through from Renault. And we're going to be listening for any commentary, of course, on the tariff impact. Renault maintaining its full-year operating margin target of at least 7%. The estimates had been for 7.26%. So it's maintaining its full-year operating margin target, aiming for at least 7%. This French car maker seen as one of the least affected by direct impacts of tariffs when it comes to European brands. Renault may delay its plan to sell some of its models in the US over those tariffs. That's according to the CFO. Full-year operating margin, again, seeing at least 7%. In terms of full-year free cash flow, they're looking at least 2 billion euros. That's slightly below the estimates of 2.09 billion. But they're maintaining, again, their full-year operating margin forecasts. First quarter revenue for Renault coming in at 11.68 billion euros, slightly below the estimate. So it's a miss on first quarter revenues for Renault in terms of the top lines. Roche in the drug maker space, lines crossing a few there as well. First quarter sales for Roche, the Swiss drug maker, meeting estimates. First quarter sales coming through at 15.4 billion Swiss francs. And Roche confirming its outlook. That stock is up just 4% year to date. The pipeline, of course, the details around the pipeline will be in focus for analysts in terms of some of the key lines coming through. On the pharma sales, those numbers beating the estimates, 11.95 billion Swiss francs. The estimates had been for 11.7 billion. So it's a beat in terms of first quarter pharma sales. Top line, first quarter sales coming in above the estimates, confirming their 2025 outlook for Roche. So earnings front and centre for us, and for now at least. taking the spotlight away from Trump and the policy around tariffs. But you will expect that to be relatively short-lived. Let's get a touch then on the broader markets, because the gains that we saw coming through across European equities and the US market as well yesterday, that upside is starting to lose momentum now as there is confusion about the direction of travel when it comes to trade negotiations with China. We'll break that story down for you. European futures currently flat after the gains of a little over 1% yesterday by the end of the close. In fact, close to 2%. European stocks ended up more than 1.8%. Today, futures are flat. FTSE 100 futures looking to losses of just 4 points. S&P futures, after the gains of 1.7% by the end of the close yesterday, currently pointing low by 0.1%. Nasdaq 100 futures off by 0.2%. Let's flip the board and have a look cross asset then. You do see a little bit of pressure on the dollar again today, so that trade is back with yields currently down around 3 basis points on the benchmark 10-year, 4.35. Euro dollar at 1.13. Strength again for the euro in the session today, up 0.2% after the softness that we saw yesterday. Brent trading at $66 a barrel, up 0.1%, and gold gaining after the losses yesterday. Some upside for the yellow metal, up 1.2%. Briefly checking on Asian markets, where again the relief rally has run out of steam. Again, at least for now, broadly across the benchmark, down 0.3%. Over in Hong Kong, losses of around 1.1%. The Nikkei in Japan gaining 0.5%, despite Japanese yen coming in with strength today on softer dollar. The yen up 0.4%. Let's get to that tariff story then. US President Donald Trump raising the possibility of a, quote, special deal with Beijing on tariffs in the next 2 weeks, 2 to 3 weeks. Take a listen.
We're dealing with a lot of countries right now, and could be with China, but maybe we'll make a special, a deal, and we'll see what it will be. Right now it's 145%. That's very high. It got there because of the fentanyl. They're sending massive amounts of fentanyl into our country.
OK, for more on this, let's bring in Bloomberg's Jill Deesa, standing by for us in Hong Kong. Jill, is this a U-turn from the US president? Is that the right way to characterise it in terms of the trading relationship, in terms of the tariff policy on China? What do we read into this?
Well, I mean, Tom, some of that really just kind of feels like Trump riffing there, right? I mean, certainly, I think it's the case. It's very evident that Trump has toned down his rhetoric on China and several other issues involving tariffs over the last few days. Whether that's because he's unnerved by what's happening with the turmoil in the bond market, whether that's because he's been meeting with a lot of industry leaders, including several from major retailers such as Walmart and Target and Home Depot, that have really warned the president of the kind of calamitous economic effects that these tariffs could really bring. I mean, whatever the case may be here, it does seem that Trump has really softened his rhetoric on China. Obviously, just a couple of weeks ago, we were in this ratcheting up of tariffs on each other, leading to that 145% rate that now Trump says is under negotiation and something that could ultimately change. I mean, he just said there, though, maybe something could come within the next couple of weeks. I think, there's plenty of reason, though, to be skeptical about what that actually looks like and what it means, because we don't really have a ton of indication that there's these big sort of foundational serious talks between the U.S. and China right now. I mean, I think that, when you're looking at all of these different trade deals, including, remember, Tom, all of these different deals that the U.S. is trying to reach to avert some of those reciprocal tariffs that it's threatened on a lot of its big global major trading partners, when that enters the equation, it really is a bit head-spinning here to kind of sit down and say, okay, wait a minute, now it's about China. What about these other trading partners? So I think there's still, the bottom line here, Tom, is just there's a lot of room here, I think, for uncertainty, and it's still not entirely clear what some of these deals that Trump is now floating in these conversations with reporters would ultimately look like.
Well, indeed, and from the uncertainty around what they plan on China to the uncertainty around the auto story, is this that there are lines coming through that Trump and the team are looking at reducing some of the auto tariffs? Is this the auto lobby getting a win here? What do we know about the Trump policy team and their thinking on auto tariffs?
Well, Tom, I think it's too early for anybody to declare a win at this point, but it is the case that the Trump administration is considering several different measures that could ultimately pare back some of these tariffs on autos. I'll just go over a couple for you. One potentially could be to spare those automobiles and their parts that are already subject to tariffs from facing additional duties that would come under, say, Trump's sectoral steel and aluminum tariffs. So that would be an idea to kind of, prevent sort of a double stacking broadening of different tariff levies. Again, I think, Tom, this kind of goes back to the fact that you've got reciprocal tariffs, you've got sectoral tariffs, you've got all different kinds of things flying around. So that's one option, maybe exempt them from things that would ultimately stack different tariffs together and create incredibly high rates. Another option would be to exempt auto parts that comply with the U.S., Mexico, Canada trade pact. That's the one that, Trump orchestrated under his first term. But again, some logistical issues there, because then it comes down to, okay, well, how exactly, do you exempt these parts from other tariffs that Trump has threatened? And then the Financial Times is reporting, sort of another option, which would be car parts coming from China. Maybe there's some exemptions there. So again, all kind of really kind of shows you here that there's a lot of different options on the table, and it's not really clear what may ultimately prevail.
OK, Bloomberg's Jill Deesis nimbly walking through the messiness of the tariff story for us, joining us out of Hong Kong. Jill, thank you. Now, Citadel founder Ken Griffin is sounding the alarm on Donald Trump's trade war as markets seesaw in response to the latest signals from the White House. Speaking at Semaphor's World Economy Summit, Griffin took aim at the US president's policies.
Unfortunately, the trade war, which has devolved into a nonsensical place, means that we're spending time now thinking about supply chains, thinking about strategically how we're going to source goods around the world. And I'll tell you what's not going to happen is people are not going to race to build manufacturing in America. Because with the policy volatility, you actually undermine the very goal you're trying to achieve.
OK, Ken Griffin there. Bloomberg's Valerie Teitel joining me now for what the market reaction is this morning. And the stock rally is losing steam. It felt tenuous to some yesterday, Val. Talk us through the reaction and how some of those upside gains have been unwound.
Yeah, that's right, Tom. The market had a really tough time yesterday trying to parse through all these signals, these mixed signals, some from the Wall Street Journal, from the FT, then denied by Trump. It was a very confusing session for the equity market. We still ended up, though, in the green, even though we ended up off the highs. And over the last 3 sessions, Tom, we're still up around 4%. So, yes, we've lost some steam recently, but there is some positivity still in the tailwind for the U.S. equity market. And I want to point to a different chart, which maybe could point out why. I know Ken Griffin was there talking about policy volatility, that we really need to clear things up for businesses. I've got a chart behind me of the U.S. Policy Uncertainty Index, which you can see maybe in some way this is not the chart that I wanted, but that's fine. I'll verbalize it for you, Tom. If you look at the Economic Policy Uncertainty Index, there's a way that you could argue that maybe we're past the peak of this economic volatility, and it essentially past the peak of the COVID volatility. And with that volatility, maybe that uncertainty behind us, that is leading us to rebound in the U.S. dollar. Take a look at how the dollar has reacted from the year's lows. It's up now almost 1% since those lows that we reached past on Monday. Maybe with this uncertainty behind us, we can move on to other things like deregulation and tax cuts, the things that the market wants to hear from the Trump administration.
Bloomberg's Valerie Teitel, thank you very much indeed. Back to the earnings story now. BNP Paribas, the French leader, in focus for us today. A beat when it comes to the equity trading story, certainly. Let's bring in and get the analysis with Bloomberg's Claudia Cohen standing by for us in Paris. Claudia, what stands out to you from the numbers coming through from BNP?
So, hey, obviously, as you mentioned, so BNP is the first major European banks to report first quarter earnings. And what we can see clearly is that it indicates that European banks were able to benefit from the global market volatility, at least as much than Wall Street banks. For BNP Paribas, the surge, for example, in equities trading revenue were about 42%, which set BNP first quarter at a record high ever since at least 2007. It was way above even the most optimistic estimate. And if we want to compare it to with Wall Street peers, the surge was 34%. So this is really a big gain for BNP. Then the other main takeaway I think is important to highlight is that BNP maintained all its targets for 2005 and also 2006.
What about the comments, any comments, Claudia, in terms of the tariff impact, particularly when it comes to credit risks, any provisions that the lenders having to put aside in this increasingly uncertain environment?
So yeah, obviously investors were looking for early signs of indirect consequences of the tariff wars on banks like BNP. So we didn't see any so far. So like we were talking about the equities trading. So investors were also looking for credit provision. So credit provision was slightly higher than the one last year, but nothing significant really. And BNP CFO was able to say that we can't see anything so far in credit provision. The only downside for BNP first quarter earning was that cost rose by 4%, which was a bit more that consensus was expecting, and it contributed to the small decline in net income for BNP in the first quarter.
Okay, Claudia Cohen, thank you very much indeed. Breaking down the BNP Paribas results on a very strong session, at least very strong numbers when it comes to equity trading for the team at BNP. We're going to bring you an interview with the CFO of BNP, so we'll get more on that story and the reaction from the CFO of that lender at 7:10 a.m. UK time. So certainly stay tuned for that interview. Back to the earnings story, this time in the telecoms equipment space. Nokia coming through some lines. In terms of first quarter net sales, it's a miss for Nokia. 4.39 billion euros. The estimates have been for 4.4 billion. Arguably, it's more interesting the line around the guidance story, given the tariff uncertainty. Nokia says that reaching the top end of its profit guidance will be more challenging. The company saying it could see some short-term disruption on the tariff situation. So lines crossing there from Nokia. That stock is up about 9% year to date. New CFO, new CEO at the helm of that company, Justin Hotard. This is his first results. So we'll be listening in as well for comments from him and the team on the call. But it's the line around the guidance that's the redhead across the terminal right now. It will be challenging to meet the top end of the guidance, says Nokia. Coming up, Donald Trump pushes Ukraine's Volodymyr Zelenskiy to accept a peace deal. We'll get to the geopolitics next. This is Bloomberg. President Trump ramping up pressure on Volodymyr Zelenskiy to accept a peace deal that critics fear will favour Moscow, while accusing the Ukrainian president of prolonging the war.
I think we have a deal with Russia. We have to get a deal with Zelenskiy, and I hope that Zelenskiy, I thought it might be easier to deal with Zelenskiy. So far it's been harder, but that's okay. It's all right. But I think we have a deal with both. I hope they do it.
For more, let's bring in Bloomberg's Russia editor, Greg Sullivan. Greg, what is the main sticking point in this potential peace deal right now? Is it territory or is it something else?
There's a few things at play here. One is that the U.S. proposals that Donald Trump has put forward, Kyiv and its allies really worry that those are heavily favored toward Russia. There are certain proposals, such as the U.S. recognition of Crimea or taking Ukraine's bid to join NATO off the table. Those have been strict Russian demands, and they're very hard to swallow for Ukraine. At the same time, there hasn't been talk about a potential security guarantee, which Ukraine would need to make sure the fighting doesn't resume. There's also an issue of whether there would be a ceasefire during negotiations of a final deal. Ukraine has said they would agree to an unconditional ceasefire and want Moscow to do the same so that there is space to negotiate further, whereas Moscow has said they want real progress towards a final deal with their onerous demands before any sort of ceasefire could take place. And even today we saw that Ukraine was struck by a very heavy missile barrage this morning. They said that it was one of the deadliest this year. So the fighting continues. Ukraine has called for a ceasefire. Those appear to be the main sticking points at the moment.
OK, Bloomberg's Russia editor with the latest on how that story is evolving. Greg Sullivan, thank you very much indeed. Switching focus, because coming up we're going to get to what's happening in the luxury space. Bit of an incongruous pivot here, but brand Gucci's first quarter sales tumbling in the first quarter. We will dive deeper into the numbers from Kering and the woes at Gucci. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Gucci sales tumbled in the first quarter, dealing a blow to parent company Kering as the broader luxury market struggles through the current earnings season. Charlie Wells is here with an update on the luxury front. Let's start with Kering and the numbers. Put them into context for us, the pressure point coming through with Gucci.
Yeah, Tom. So I'm just going to have to say this kind of well-known maxim in the luxury sector, which is when Gucci suffers, Kering suffers. And Gucci in the first quarter suffered. So the revenue was down 25%. That was worse than expectations. Painful. And the reason why this is so painful for Gucci and then for Kering, it's because 60% of Kering's profits come from Gucci. And that is a much bigger proportion than for these other large luxury houses, in particular arch rival LVMH, a little bit more diversified. And so, this is why these numbers are bad. They were, LVMH had disappointing numbers, Hermes had disappointing numbers, but these Kering figures are particularly bad.
Okay, because of that exposure to Gucci as you break down for us. So give us that top line in terms of what we've seen so far from the European luxury space and how things are holding up or not.
Yeah, so it's been disappointing. I think there's been this kind of triple whammy of effects. So you've got slowdown in China that's coming through. That's a hugely important market for these large European luxury houses. You're also seeing some slowdown in the United States. And then you're also getting all these trade and tariff woes, right? And that is potentially hitting into margins of these companies. But it also has this issue of the kind of reverse wealth effect, where when markets are choppy, when markets are down, consumers feel less rich and they feel like they can't splurge quite as much. And this is translating into what's been a pretty dramatic few days as these luxury houses have given us updates on sales. We had a moment where there was, some bad numbers out of LVMH. We had a moment where Hermes's market cap actually overtook LVMH's for the first time. It's since recovered, but they're kind of neck and neck. And now we've got these, disappointing numbers from Kering. So pretty dramatic.
Okay, so we'll see if any of those elements turn around, whether it's the tariff story or China's consumers coming back for the luxury story. Talking of consumers, a different end of the consumption market, or a broader look, arguably, beyond luxury, which is Nestle, and this time, of course, focused on largely food products. What is standing out to you from the Nestle earnings that dropped at 6 a.m. UK time? So
look, they beat expectations, and it's seeming like they're able to pass on some of these higher costs on, cocoa, on coffee onto the consumer. But they've got to tread carefully here, because Nestle has been on this sort of long and difficult trajectory. They really struggled during that period of higher inflation because, they tried to pass on higher costs on a lot of their goods to consumers. Consumers pushed back and they traded down. And so Nestle has been talking about how they need to advertise more. They need to make sure that consumers, want those products that are higher margin. And it's going to be really interesting to hear on this call in a few hours about how they're getting that kind of product mix right, because, they do face tensions from trade. They do face tensions from higher coffee and cocoa costs, but they also need to keep that consumer. So that's a difficult line to cross.
Okay, we're showing a 5-year chart there. Year to date, the stock is actually up 20%. So we'll look out for those details. Charlie Wells, thank you, breaking down some of the key earnings for us. Other stories making the news this Thursday. Louis Vuitton, talking of luxury, has raised the price of one of its most popular handbags in the US after President Trump imposed a 10% tariff on goods from the EU. The Neverfull GM bag in monogram-coated canvas now costs $2,200. Charlie Wells is an owner of one of these bags, $100 more than last week, allegedly. A Bernstein analyst says not all Louis Vuitton goods are affected, with some products made in the US. Adidas has reported better than expected earnings in the first quarter as consumers continue to snap up its retro sneakers. The German sportswear company posted an operating profit of 610 million euros. That's above the average analyst estimate of 545 million euros. Adidas continues to ride a 2-year hot streak with strong demand for classic shoe models, including the Samba and the Gazelle. What are those socks? Coming up, traders digest Donald Trump's tariff talk as he signals a special deal with China. We get more on the markets. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The global relief rally loses steam. Asian stocks snap a 5-day winning streak on mixed signals from the White House on its China tariff plans. Ramping up the pressure, Donald Trump calls on Ukraine's Volodymyr Zelenskiy to accept a peace deal that critics fear could favour Moscow. Plus, European earnings ramp up. France's BNP Paribas reports record income from equities trading. Nestle sales rise after the world's biggest food company hikes prices, but Gucci reports another drop in sales amid softening demand for luxury. Staying on the earnings story, the Swiss pharmaceutical company Sanofi, in terms of first quarter business earnings per share, that is a beat for Sanofi in the first quarter, 1.79 euros per share. The estimates had been for 1.67. The company is confirming its 2025 guidance. First quarter sales at a constant FX rate came in at an increase of 9.7%. Operating income in the first quarter was a solid beat for Sanofi, 2.9 billion euros. The estimates had been for 2.66 billion euros. So our eye and focus on the earnings story this morning, of course, continuing to monitor the Trump policy agenda when it comes to China and tariffs. Talking of which, let's get a broader gauge on these markets then. A softer session over in Asia, as we mentioned. European futures then, after the gains of 1.8% yesterday, pointing lower by 0.1%. FTSE 100 futures also off by 6 points. S&P futures, after rallying yesterday, currently pointed to losses of 0.2%. Nasdaq 100 futures that gained as well, a little over 2% by the end of the close, currently pointing lower by 0.3%. Let's flip the board and have a look cross asset. You do see a bid for treasuries. Yields are down across the curve so far in the session, down about 3 basis points on the benchmark 10-year at 4.35. Euro dollar, the single currency getting a lift on softer dollar again today, up 0.2%. That's after weaker euro yesterday. Brent at $66 a barrel, up 0.1%. We watch for details on OPEC Plus and its potential output supplies. Gold's rallying in the session up 1%. It lost, of course, there was some profit taking arguably on the yellow metal yesterday, currently at 3,323 per troy ounce. Gold gaining again in the session. Briefly checking in on the Asian markets. That momentum has fizzled then. Currently down 0.3% across the benchmark MSCI Asia Pacific. Over in Hong Kong, the HSI is down 1.1%. The Nikkei up 0.4. That's despite the fact that you've seen some yen strength in the session, up 0.5 on the Japanese currency at 142. The Nikkei gaining 0.4%. Let's get a broader look on these markets now. Very pleased to say I'm joined by Alexandra Ivanova, fund manager at Invesco. Alexandra, thanks for joining us bright and early in the studio this morning.
Thank you for having me.
Some investors have been taking the lesson from the recent days, the U-turns around Powell, the U-turns around the Trump policy on China and how the tariff story there could evolve. The lesson being, arguably, that the markets are now a constraining factor, that this president is sensitive to moves in both the equity markets and arguably, more importantly, in the fixed income markets. What does that signal for you as an investor as you think about positioning in the weeks, months and years ahead?
Well, it's very difficult because the volatility in terms of the headlines that are coming in are so uncertain, and we have seen a lot of U-turns and then the U-turns on the U-turn, so who knows what's coming in the future. But I do think that it makes sense to have those kind of guardrails in a way that it gives us some kind of a range. I don't know whether that range will continue to hold, but for active investors and the investors who are able to move allocations between asset classes or within asset classes, there is some kind of opportunities that come through with this volatility. I know it's difficult to do it, and sometimes it's difficult to execute on a very risk-off days, but overall, I think it makes much more sense to be diversified, but also being active helps. Okay,
and I want to get your views on some of those opportunities. But before I do that, broadly, on the US asset story, Jefferies Global Head of Equity Strategy coming out and saying that US equities have now peaked, and he sees further downside potential for both stocks, but also fixed income and the dollar in the US. Does that align with your view? It's a bearish call, again, on the US story. Do you align with that, or is it more nuanced?
It's quite nuanced. So on the equity side, I think even with the recent sell-off, we still, valuation-wise, is not as cheap. They have underperformed all the other major equity markets, and I do think that most of the move that we have seen so far has been mostly fast money moving quickly out of U.S. stocks into other equity markets or other asset classes, for that matter.
Where are we in that journey?
And I think first leg of it is much more sentiment driven, But I do think that there's going to be some strategic reallocation of long-term investors into different asset classes and trying to be much more diversified and balanced. I'm not saying that everybody is going to sell equities in the US, but having some kind of exposure to non-US equities in this environment actually makes much more sense.
And what additional risk premia do you expect to be priced in to US assets then, medium to long term?
Yeah, so part of it, so thinking about bond markets, the Fed independence, that was implicit, and it's kind of a safe asset. But as soon as you start talking about the lack of independence, you have to price in that risk premium, which makes the safe asset a risk asset. And it's changing on a daily basis, and it's very difficult for investors to use it as a hedge or use it as in the multi-asset portfolios as a way of diversifying away your risk. So in a way, I think that it gives us more opportunities to look elsewhere outside of US.
Where is your strongest conviction in rates at this point?
In rates, I still like European bonds. But I would say we have been quite active. So we've come into the year thinking that treasuries were quite attractive. Then we had the gilt volatility. That gave us good opportunity to enter gilts. And then once we saw the fiscal risks and inflationary impulse that comes from the German fiscal expansion, repriced the bonds. And that was, for me personally, it was a very good entry level to buy into the bond market and reducing our exposure to treasuries. And that has worked really, really well. At the moment, I'm kind of thinking, have we moved quite significantly already, maybe starting to dial back to U.S. treasuries, maybe in the belly of the curve, not necessarily too far into the longer end.
Okay, that's interesting. Maybe dialing back into the belly of the curve when it comes to U.S. treasuries. On credit, are you seeing, are the fundamentals holding up? The spreads are still tight. The fundamentals still holding up. Are there risks of that starting? Are you seeing any evidence of that starting to crack, that story?
So fundamental picture is still quite strong, but we are seeing weakening forward guidance or no guidance. So that is quite difficult for investors to look through this weakening environment in the macro picture. But from credit perspective, I'm actually thinking in terms of you have two sides of the story. You have the recessionary risk, which is quite negative for highly levered companies. And then you also have this kind of focus on balance sheet from companies. And that makes it much more investable asset class in the longer term. Yields are relatively attractive. The spreads are tight, and they have widened out more recently, but not necessarily to a screaming buy yet. But we look at the overall yield level, and it's quite appealing for long-term investors just to buy and hold.
How are you factoring tariffs into your sector-by-sector credit allocation?
So it is a sector-by-sector, depending on, so autos, for example, has been, it threw some opportunities for us to trade out of weaker names into better names, and then the weaker names actually have been pricing quite a lot already. Then you kind of moving it back, barbelling it. Maybe that's the strategy in my view. Within each sector, you might also see some companies that are not necessarily that cyclical or will be impacted as dramatically by tariffs. So you need to look at individual companies, their balance sheet, their ability to generate revenue, continue to keep their margins, and cash generation is still strong. So do the name selection.
Do your homework. Yeah. Do your homework. Okay, Alexandra Ivanova helping us with some of that homework this morning. Thank you for joining us in the studio with a breakdown in terms of how to think about positioning in credit, fixed income, and of course the equity story as well. Fund manager at Invesco. Now to the macro. Bundesbank President Joachim Nagel says Germany's economy is in danger of suffering a recession this year due to the impact of US tariffs. Nagel spoke to Bloomberg at the IMF's annual spring meeting in Washington.
This year, I guess this meeting is a very special one. I think the world economy is in a very delicate situation, and I will use this time here to learn a little bit more what we can do to make it better, to make the economy running, have a better understanding what's going on. And there are really a lot of uncertainties.
One of the uncertainties is what's coming from the United States in particular when it comes to tariffs and how much that not only is a ramification for the U.S. economy, but also the global economy. How are you thinking about tariffs and how much they could depress growth, say, in Germany?
I said a couple of months ago, when it comes to tariffs, I was of the opinion that this will trigger a lot of problems. And now we see how the problems evolved over the last couple of weeks and months. And so we have to have a better understanding how we can find, let me say, a kind of a compromise, a kind of a level playing field that brings us closer together, because tariffs are not a good policy. This is for sure.
If they stay, is there a sense that it gives you more room to cut rates?
I think, first of all, I guess we have to take into account as central bankers also tariffs. What does that mean for Europe? I guess when we're talking about monetary policy in the Euro system, we are on a good path. I guess we can come close to price stability over the course of this year, and this is good news. But there's a lot of uncertainty. And so we said last week, because of that, we have to be very cautious. We have to wait what might come, how this uncertainty might evolve over the next week. So we have this meeting-to-meeting approach, and this, I guess, is the best way to conduct monetary policy.
Bundesbank President Joachim Nagel speaking to Bloomberg's Lisa Abramovich at the IMF's annual spring meeting in Washington, D.C. Now, some other stories making the news this Thursday. Chancellor Rachel Reeves says the UK is not in a hurry to strike a trade deal with the US, highlighting that she's prepared to stand by Britain's red lines. Reeves is set to meet with US Treasury Secretary Scott Bessent at the IMF meetings in Washington tomorrow. Speaking to journalists, she ruled out weakening food safety standards and online protections. European car sales returned to growth last month for the first time since December, driven by gains in the UK and robust demand for electric vehicles, making up for weaker sales in Germany and France. According to the European Auto Manufacturers Association, new car registrations rose 2.8% in March compared to a year ago. The growth in EV sales did not extend to Tesla, though, which saw new registrations fall 28% in Europe last month. Coming up, digital lender Zopa Bank doubles its full-year profit against a backdrop of a lacklustre UK economy. We delve into the state of the UK consumer with the bank's CEO. That's next. This is Bloomberg. Turning to the digital banking space in the UK now, British lender Zopa Bank doubling its full-year profit to just over £34 million for 2024. The results mark the company's second consecutive year of profitability amid a lacklustre UK economy. Joining me now is the CEO of Zopa Bank, Jaidev Janardana. Jaidev, thanks for joining us in the studio. What was behind the growth in profits then for the company, for the business in 2024? What were the catalysts?
I would say I'll thank my customers for that. Our customers continue to love our products. So we've seen about 30% growth in our customers, both borrowers and savers. And as a result, that drives a 30% increase in revenues. We are a digital company, great operating leverage. More of that drops to the bottom line. This profit doubles.
Does that growth in customers, 30% growth in customers in 2024, do you project the same kind of level of growth in 2025? How is that picture looking?
Yes, I mean, we are in the midst of, a bit of uncertainty. But if things look the same as they do today, the economy remains to be about growth of 0.5% or so, and unemployment doesn't rise, then I would expect, again, 30 to 40% increase in customer numbers this year.
30 to 40% dependent on the macro picture. Talking of the macro, you have a finger on the pulse of the UK consumer, or at least a segment of it. Are you seeing stress there? You've seen your customer numbers coming up, but are you seeing any signs of stress, any signs of delinquencies on your loans? That's starting to pick up?
I think the UK consumer health remains... they're stretched, but still resilient, is what I would say. We are seeing I would say, responsible behavior in terms of subdued borrowing demand and a bit more savings, and particularly now with the ISA season coming in and the market turmoil, more money kind of moving into the cash ISA space. But we're not seeing signs of stress yet. And in fact, over the last 3 to 4 months, we've seen consistent increase in real incomes as income growth has been ahead of inflation. And that is starting to actually see some improvement in credit, if anything.
Okay, some improvements in credit, higher wages, but cautious, maybe more in savings than in debt. Talk to us about the journey. You kind of move from you've gone from kind of P2P to being a digital lender now in a very competitive space here in the UK. What is the next key platform for that transformation of the business? Yeah,
so we started for focusing on the borrowing and savings needs of UK consumers. I think this year for us it will be really stepping into everyday banking. So we want to widen our product offerings, offer the UK consumers a better current account. That's one, as well as kind of more investment opportunities. We feel the retail consumer in the UK doesn't invest as much as they should, and we would love to encourage more of that as well. So those will be the 2 things that we focus on this year. Okay. It sounds like you're going to be taking on Robinhood to some extent in that space. It is competitive. You've got the likes of Monzo, you've got the likes of Starling, Revolut, of course, is a giant in the space, Atom Bank as well. Do you see consolidation? Are there too many players at this point? There's a lot of businesses out there, fintechs and neobanks, offering quite similar products. Is there a need for consolidation? Do you see that happening? I think there's an opportunity for consolidation. I wouldn't say there's necessarily a need for consolidation. I do feel that consolidation can help some of us take on the incumbents in an even better way. But each of us, actually, if you look at it, most of us are growing still at a pretty rapid pace. And for us, we are profitable and we're continuing to actually see a lot of market opportunity in terms of growth.
The priority for you, organic growth, or would you consider an acquisition?
We would consider acquisition. We have done one in the past 2 years ago when we acquired a business that helped us enter the space around BNPL and point of sale finance. So we continue to remain open to acquisitions and in fact actively looking for things that can help us diversify our product set or help us serve a different customer segment. So definitely open for that.
International expansion, I talked to you the last time you were on the show, the focus on the UK. But what are your international expansion plans? How are you thinking about that? How's that story evolved?
I would say that our focus continues to be on the UK in terms of we see a lot of opportunity. We're just scratching the surface in terms of the customers we can serve and the products we can offer. So there's a lot of opportunity in the UK. So any international expansion will be more opportunistic and inorganic rather than organic.
Okay, give us an update. Given the profitability, two years now, profitability for the business. What are the IPO plans?
As you can see, as you were talking earlier, the markets continue to be somewhat challenging.
Might be,
yes. Yeah. So for us, the focus is really on growing the business and making sure that the business continues to do well for its customers and for its shareholders and for its employees. As and when the markets get to a better place, and I can't forecast when that would be, we will consider an IPO, but that's not a priority for the business today.
Okay, not a priority, but when the markets get back to some kind of normalcy, if and when, that might be an opportunity. You feel match fit for that?
We do. So as a bank, we have all the governance controls, processes that are in there. The business is profitable, which is something and growing well. So as a business, we feel we are ready for it. Okay. But yeah.
Jaidev, thanks for coming in on the back of the results from Zopa Bank as well. Second year of profitability. Jaidev Janardana, the CEO of Zopa Bank. Thank you. Now, some other stories making the news this Thursday. Bloomberg has learned that UBS, talking of banks in a slightly different space and scale, is in advanced talks with alternative asset manager General Atlantic. A strategic partnership would see the Swiss bank push into the $1.6 trillion private credit market. According to sources, the partnership will aim to make loans of as much as $500 million and will focus on borrowers in North America and Europe. The Financial Times is reporting that China is getting ready to remove sanctions it placed on European lawmakers 4 years ago. It's a move that could lead to the revival of an investment deal between the two sides, just as punishing US tariffs hit China's economy. In 2021, China retaliated against Western sanctions on human rights practices in its Xinjiang region by announcing measures against individuals and entities from Europe. SK Hynix is warning of increased volatility in the second half of this year amid uncertainty surrounding US tariffs. That's despite the South Korean company seeing resilient demand for AI memory chips from big tech providers. The company reported a better than projected 158% jump in March quarter operating income, driven in part by stockpiling ahead of Trump's tariffs. And IBM shares dropped in extended trading after reporting results that showed strong profit but suggested US government cost cuts led by Elon Musk's Doge may dent the company's business. The company's CEO expressing caution about the economic environment, describing it as, quote, fluid. Plenty more coming up. Stay with us. This is Bloomberg.
There is currently, as I said, no inflationary risk in Europe. And we can almost say mission accomplished when it comes to bringing inflation back to our 2% target. The significant deceleration of wages is another proof thereof. It is therefore both fair and appropriate that compared to the US Fed or the Bank of England, the ECB has started cutting rates earlier, last June, faster, and likely further this year.
ECB Governing Council member, of course, Francois Villeray de Gallo there on the ECB and the rate cuts that come through. A lovely bit of colour coming through from Neil Dutta, switching focus to what's happening in the S&P 500 of Renaissance Macro Research, linking the headlines coming through from some of Trump's key policy advisors, of course, the likes of Peter Navarro, Howard Lutnick, of course, the Commerce Secretary, and then Scott Bessent on the other side. And what he has discovered through pairing some of these headlines to the S&P 500, ultimately, when the news headlines are dominated by Scott Bessent, you get some upside of about 52 points in the S&P 500, but downside of around 13%, I should say, 13% when it comes to Peter Navarro and Howard Lutnick, and if their stories are dominating the headlines. So just something to bear in mind. Ultimately, we are seeing, of course, the market starting to hem in President Trump, at least to some extent. We've got Alphabet earnings coming up, focus on cloud, focus on AI. The open trade, though, is up next. This is Bloomberg.